Hello and welcome to my morning note. You might have noticed that stock markets have been doing really rather well recently. Indeed, the US stock market has been at all-time highs. But very rarely that's been achieved even though cyclical companies, which are most prone to the economy, have actually been falling and underperforming quite badly compared to defensive stocks, those big economic castles with round economic moats that can survive even tough economic conditions. It's a very strange kind of a rally. What's going on? With me now to discuss this is Goldman Sachs' Chief Global Equity Strategist, Peter Oppenheimer. Peter,
hello,
thanks very much for coming along today. Let's start by taking a look, both in the Europe and the US. The underperformance of bicyclicals is getting really very marked. What do you think is going on?
Well, I think there are a number of factors behind this, but one important one is that the equity market is going up, I think, not because people are repricing growth, as is often the case when you get strong rallies, but because liquidity is really driving people up the risk curve into equities from other assets which are yielding so little. And in that sense, people, I think, are looking at equities that are relatively safe.
Right, so in many ways the fact that the levels are where they are at the moment is thanks to central bank action rather than to optimism about the economy. So let's now take a look in more detail at how we define cyclicals. On this chart, which comes from Goldman, it looks as though resources-based cyclicals have been underperforming for quite a while, whereas the others have only recently gone off the boil. Is that being driven by the China effect, or what's going on there?
Well, I think, John, there are really two factors behind this. One of them, as you say, is the China effect, that China and other emerging economies have been somewhat weak. Their economic cycles are slowing, and therefore things that are seen to be very sensitive to that have been relatively weak. But I think there's another story as well, which is that resources in particular have been underperforming, as lots of investors, ourselves included, believe that many commodities have passed the sort of peak of their super cycle, and some of the margins and rates of return on capital are beginning to come down.
Now let's look at what they are actually paying for then. And this is very interesting. As I understand it, what this shows is that the premium for companies that are growing their top line is widening. Meanwhile, the premium for companies that can actually make profits doesn't seem to be out of line with historical norms.
Right.
So is this also another rather conservative preference? Does this mean that people just don't believe the earnings numbers?
Yes. Now, first of all, we have to bear in mind that the equity risk premium is still very high. It has come down from its peak levels, but relative to history, very high indeed. And there tends to be a relationship that when you have a high risk premium, a high level of uncertainty, that people shorten the duration or their the perspective of investment and prefer things that they can see are delivering returns now. That tends to be more top-line growth rather than earnings, which are much more dependent on margins and the economic cycle.
Okay, and it tends to be defensive companies like retailers, consumer goods companies that are producing a decent top line at the moment.
That's correct. So the companies that may have a decent through-cycle earnings advantage, but where that is dependent on margin expansion, investors are really not paying a premium at the moment because they're quite sceptical about the prospects for these kinds of companies, and that's really where I think there are still some opportunities.
Okay, now one final question. From the earnings data that we've seen so far in the US and Europe, it looks as though earnings per se have been somewhat ahead of expectation, but there has been really rather a disappointing story on the top line. And does that mean that we will continue to see a premium for that top line growth if it's relatively rare?
Results have been slightly better, but that's based on revisions that came down quite a lot going into the season. But you're right, top line growth has been weaker in general, and that shows that the global economy is still relatively weak, and therefore I think the premium for companies that can sustain top line growth is still likely to be pretty attractive, especially if those companies are also decent dividend payers with strong balance sheets, because the liquidity shift into yield, people searching for yield away from cash and government bonds and credit, is still resulting in some interest in these kinds of companies, we think.
Okay, Peter, thank you very much indeed.
Thank you.
I think in summary, there are many people who are very worried about the phenomenon of continuing outperformance by defensives. You even hear the word bubble being mentioned by some people, but for all the reasons we've just been discussing, it's hard to see this trend ending anytime soon.